We are constantly bombarded with stock picks, hot tips, and breaking financial news. The temptation to outsmart the market and find that one explosive trade is practically unavoidable for the modern investor. But before we try to outmaneuver the system, we have to look at the people who do this for a living. If highly paid Wall Street professionals, armed with supercomputers and teams of analysts, struggle to beat the market, what chance does the average person have? This chart shows the aggregate returns of actively managed mutual funds compared to a baseline passive index, like the S&P 500, over a 5-year period. The data comes from the SPIVA scorecard. SPIVA stands for S&P Indices versus Active, and it tracks the performance of active managers against their benchmarks. The trend here is clear. The vast majority of professional active funds fall significantly short of a simple passive benchmark. Even if you manage to find a winning fund, that success rarely lasts. According to the S&P Persistent Scorecard, out of the top quartile funds in any given year, virtually zero maintain that top position over the next 5 years. They quickly slide into the lower ranks or disappear entirely. When the best track records in the industry cannot be sustained, it reveals a hard truth. For most professionals, beating the market isn't a repeatable skill. It is just a temporary streak of luck. As bad as those numbers look for professional stock pickers, the reality is actually much worse. The public data is skewing our perception of their success. This happens because of a statistical flaw called survivorship bias. Survivorship bias occurs when researchers only evaluate the entities that survive a certain process, ignoring those that failed. A comprehensive study by NYU Stern researchers showed that when we measure mutual fund performance, we often only look at the funds that survived the entire testing period. This scatter plot represents hundreds of mutual funds over time. When actively managed funds perform poorly, investment companies quietly liquidate or merge them into other funds. Their negative returns are completely erased from the historical databases, causing the average return of the surviving funds to artificially jump upward. The financial system systematically buries its failures. Once you account for the funds that didn't survive, the statistical probability of picking an actively managed fund that consistently wins becomes astronomically low. To understand why failure is so common, we have to look at the underlying math. Nobel laureate William F. Sharpe laid this out in a famous 1991 paper called The Arithmetic of Active Management. Sharpe's logic is built on a simple premise. The stock market is made up of two groups, active traders and passive investors. Because these two groups combined own the entire market, before any costs are factored in, the aggregate return of all active traders must exactly equal the return of all passive investors. But trading isn't free. Active managers pay for research, commissions, and salaries. These costs are a permanent drag. Because returns are equal before costs, but active managers bear higher expenses, the math dictates a definitive outcome. After costs, active management must underperform. This mathematical reality is compounded by the efficient market hypothesis. This is an economic theory stating that asset prices fully reflect all available public information. With millions of participants instantly reacting to public data, finding easy, mispriced stocks to offset those high trading fees is incredibly rare. When you combine perfect information distribution with the heavy drag of trading costs, you are left with a stark reality. For the aggregate average investor, beating the market is a mathematical impossibility. If the math so clearly works against active trading, why do millions of people log into brokerage accounts every day to try their luck? The answer lies in behavioral finance, a field that merges psychology with economics to explain how humans make financial decisions. Psychologists Daniel Kahneman and Amos Tversky introduced prospect theory, which proves that human beings do not act like rational, calculating machines when dealing with money. Prospect theory relies heavily on a concept called loss aversion. This is the psychological principle that our brains are hardwired to feel the pain of a financial loss about twice as intensely as we feel the joy of an equivalent gain. These intense emotional swings drive herd behavior. When prices soar, greed pushes investors to buy at the top. When markets crash, The overwhelming pain of loss aversion causes them to panic sell at the absolute bottom. The very evolutionary traits that kept early humans alive, reacting quickly to fear and following the crowd, perfectly wire us to destroy our own wealth when navigating modern financial markets. Yet, despite the math and the psychology, there are a few rare individuals who do consistently beat the market. Looking at how they do it shows exactly what you are up against. First, there are the quants. These are quantitative analysts who apply advanced mathematics and computer programming to financial markets. Mathematician Jim Simons built Renaissance Technologies, a hedge fund that uses vast arrays of supercomputers and armies of PhDs to exploit microscopic, fleeting market inefficiencies. Even with all that computing power, Simons' legendary medallion fund only wins 50.75% of its trades. That shows how razor-thin the margin of success really is. They are basically flipping a coin, but doing it millions of times a day to turn a profit. Then there are the value investors. Warren Buffett built his fortune by completely ignoring the emotional crowd. He strictly analyzes the fundamentals of a business and buys companies that are trading for less than their intrinsic value, holding them for decades. There is also a small sliver of retail traders who succeed. A study from the University of Michigan's Ross School of Business found that roughly the top 10% of individual traders show persistent skill. They often succeed precisely because they trade small positions and aren't bound by the bloated, restrictive rules of large institutional funds. To actually achieve true outperformance, you need either a massive technological empire or an almost superhuman level of emotional detachment. These are traits that 99% of the investing public simply do not have. If you don't have a server farm and you aren't an emotionally detached billionaire, you have to look at the data and make a rational choice about your money. The undeniable, mathematically sound solution is to buy low-cost, broadly diversified passive index funds. An index fund is a mutual fund or exchange-traded fund designed to exactly mimic the performance of a specific financial market index, like the S&P 500. This strategy works because it harnesses the overall long-term growth of capitalism. You aren't guessing which specific company will win, you are betting that the economy as a whole will grow. By doing this, you entirely bypass the mathematical drag of high trading fees and avoid the psychological trap of trying to time the market. Buying an index fund is often dismissed as settling for average returns, but as the data proves, capturing the true market average means you are mathematically
outperforming the vast majority of highly paid professionals. The statistics are uncompromising. For almost everyone, the only way to truly win is to refuse to play the active trading game at all.